Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. At last, some of you might feel we're going to be talking about something other than the Saba capital campaign against what it calls the miserable 7 investment trusts, where it's been roundly defeated in its attempts to change the boards at 6 of the 7 trusts, with one more vote still to come. So this week I thought it would be time to talk about something else, and very much, I think, topical is to talk about what's happening in the alternative sector, where we have been waiting for some time now for an improvement in general sentiment towards those sectors. A lot of people were hoping for movement last year and indeed possibly the year before, but it hasn't really happened for a whole variety of reasons. So here to talk about that with me is Matt Hose, who is the alternatives analyst at Jeffries, the investment bank and broker. So, hi Matt, good to talk to you. We're recording this on the 6th of February, which is a Thursday. And we've been seeing some encouraging news on interest rates this week. The Bank of England has cut its interest rates, and bond yields in the US appear to be finally softening a little. So before we talk about perhaps the underlying issues here, let's just get your reaction to that. So this is an encouraging development for as far as you're concerned, I imagine.
Yeah, it should be. I mean, if we think about infrastructure and renewable funds, what matters is actually the long end of the curve, sort of 20, 30 year. But look, in terms of sentiment, yeah, rate cuts are helpful. They haven't been as helpful as we would have liked for the rate cuts we saw last year. But I think a lower interest rate environment should be more supportive. So fingers crossed, yeah.
So it's been a long time. Perhaps we could just list some of the issues that the sectors have been facing. Obviously, higher than expected interest rates last year were a key factor. We also had this rumbling issue around cost disclosure and how the double counting of costs might be impeding demand for many alternative asset classes. And at the same time, we've also seen perhaps a surprising lack of corporate activity, certainly in the general infrastructure and renewable space, less so than in commercial property. Now, this week we saw that there was an announcement by BBGI that it's agreed a takeover effectively by a large Canadian investment institution. We're not talking about that because you are restricted on that one by virtue of your firm working for one of the parties. But what is your general outlook for the alternative sector in the next 12 months?
So there's been numerous issues at play within the sort of listed alternative space for, well over 2 years now. As you say, cost disclosure has been one, interest rates has been another. And I think the net result of that is we've had this sort of technical malaise where in classic sort of broker talk, there's been a lot more sellers than buyers. And I think that malaise is reflected in share price discounts. We, on the whole, believe NAVs, but it's a technical problem in the market is keeping things on wide discounts. Now, if we look forward into 2025, I just think we're going to see lots of different types of activity. So we may see sort of classic corporate activity, so mergers and acquisitions, but also there may be things like various funds changing their business models to try and broaden their investor base, whether that's in what they're actually investing or how they present themselves to the market, because one approach from funds could be to seek a sort of main market listing rather than an investment company listing. We'll see things like continuation votes, discontinuations as well. So I think either way, it's going to be a very sort of active and busy year for the alternative names.
Would it be an exaggeration to say that the current situation cannot really persist? It's been 3 tough years now, and basically, unless something improves either from internal initiatives or external market movements, as you say, something's got to happen. We've got to resolve some of these situations, particularly those where we've got significantly wide discounts that are wider than perhaps most shareholders can go on tolerating.
No, I think that's completely spot on. If discounts persist, then external factors come into play, and whether that's corporate activity or whether that's activism. And I know you've been discussing Saba at length on recent podcasts, but there's a question we often get is, would Saba be involved in the alternative names? And we don't know for sure, but what we do know is that if the opportunity set was to go away in the sort of equity-focused funds, then maybe they may look at the alternatives, or maybe other activists with different approaches will look at the alternative names. I mean, we've seen sort of sporadic activism activity, but if things don't change, then it's fair to say that we could see a lot more.
When you talked about changes to business models, Can you give me some more detail on what actually that might involve? So what are you actually suggesting here? Perhaps you give us an example where there's a trust that might change its business model. Are you saying that's separate from possibly changing your listing, where you go from being an investment company back to the main market as an operational company? Or are you talking about the same thing there?
No, it's actually two separate things. So when I say changing business model, I think there's a number of funds out there where their returns are in this sort of 7-8% range, which 3 years ago, that was a decent pickup versus long-term gilt yields. But today, that's much less of a pickup. And in essence, their real return has collapsed over recent years. And so there's a question of, do those types of funds need to move sort of further up the risk return spectrum? And there's various ways to accomplish that. It can be to sort of rotate their existing portfolios, or it can be to move into things like construction or development exposure. And if we look at the renewable universe, there's certain funds out there with development pipelines where there's sort of an interesting return profile, but they can't fund those development pipelines at the moment because they're cash constrained and they haven't repaid enough RCF borrowings. So it's that the change of listing is almost like a presentational change. And we've seen this with Taylor Maritime, where they're moving to the main market because really the focus of the business is not driving a NAV via asset acquisitions and disposals. It's about managing an earnings number. And it feels like the main market's a better place for them to do that with a potentially broader investor base.
Yeah, that's an interesting point, isn't it? Because in theory, I mean, there shouldn't be much difference in the way that these companies are rated wherever they're listed. It shouldn't really make that much difference. So why do you think that is? Is that because of cost disclosure and things like that, which is a purely presentational issue? What's the logic behind that? What's the sort of driving logic behind that? Why there is that disparity?
It's partly cost disclosure, but actually the cost disclosure has been a fairly recent issue. And the long-standing issue is mainstream fund managers don't like to buy funds. And I think there's two main reasons there. Number one is they don't want to be seen to subcontract part of their portfolio to another manager. And also it's the fee thing, in that they don't want to seem to pay an explicit management fee. But my argument is you have to pay management costs either way. If you've got an internalized managed company with a management team, then you still have to pay their salaries and their S-tips and their L-tips. And a management fee is just another way, a quite efficient way to pay a management team. That sort of opposition to buying funds, I don't think will change. But what funds can do is almost, work their way around that problem and change their listing and change the way they present themselves to the market. So the same assets, but optically a different structure, and hoping to broaden your investor base as a result.
Right. So I think that's an interesting observation, because if I'm just thinking about the investment trust sector as a whole, that's quite a negative for the investment trust sector. But I guess it was because back in the day when many of these trusts came to market, we were in a low interest rate environment and so on. And so it was easier perhaps to sell this as a yield vehicle. There was less competition in a way. So do you think basically this is another factor driving some consolidation in the investment trust sector, or reduction in the number of investment trusts we're going to see over the next couple of years?
Yeah, look, there's multiple factors that are going to drive a smaller sector in the sort of medium term, and that's one of them, to be fair. I mean, there's a number of funds which now I just don't really justify their existence given their sort of small size and liquidity. We'll probably see more M&A activity, more boards being proactive and potentially sort of throwing in the towel. But I mean, I'd make the argument that the investment trust sector almost doesn't stop at investment trust. There's things that look, which are investment trusts, and they've got similar assets to investment trusts. They just aren't technically investment trusts. And so the sector is somewhere on an asset spectrum.
Yes, indeed. And you mentioned one example of renewable trust moving into development activity is going up the risk profile. But going up the risk profile has its own dangers, of course, as well. Do you think that there is demand for that, as opposed to a lack of demand for what is on offer at the moment in some of these cases? Or is there actually going to be demand for higher risk entities? Or is it just this is sort of one of the only ways in which existing business models can be tweaked?
I think there is demand. We see it with more higher risk return strategies, and that makes sense because we're in a higher return world than we were 3 years ago. The big sort of question that overhangs it, though, is, if you think about any individual fund, is are they best placed to make that move? So have they got the right governance? Have they got a board with the right experience? And have they got a manager who basically knows what they're doing in the area? If you've got a manager that focuses on quite stable core infrastructure, are they best placed to move up the spectrum by buying higher risk return things? I think that's the big question.
Right. So, well, you mentioned TMI, the shipping company. Can you give us another example where that issue might be pertinent?
I mean, with TMI, it's a listing change, but on the renewables is where people are looking at them and questioning, should they move up the risk return spectrum because of those development pipelines they've got? And because, they have very cash generative portfolios of operating assets, but they've taken a lot of the efficiencies out, a lot of the low hanging fruit out of those portfolios. And what's the way forward, I think, is the question.
Yeah. Okay, so let's just talk then also about something else you mentioned, which is continuation votes, and also there'll be some trusts which are going to be triggering tenders and so on because their discounts have remained wide. Can you give us an example there of a trust that is facing a continuation vote, which might have implications for what happens to the value of the shares?
I'd focus on a group of trusts because they've all got similar mechanisms. If you, again, go back to the renewables, most of the funds in that peer group were launched with sort of discontinuation vote provisions. So if the discounts are wider than 10% over the reporting year, then they trigger a discontinuation vote. And that's normally a special resolution, so it requires 75% to pass. Now, discounts have been wide for up to 2 years now. So a lot of those funds triggered these discontinuation votes last year. And at the point of the votes, shareholders generally gave the funds a pass because they'd outlined asset sale programs and it was fairly early days in the discounts being wide. So shareholders are right not to hit the sort of panic button. But I suppose now we're a year down the track. A number of the funds have been relatively slow to make asset sales. And so the question is are we going to see different results in those votes? We're going to see more shareholders potentially voting for discontinuation.
A couple of examples I am aware of is there's Foresight Solar, I think, and also Greencoat UK Wind, which is the biggest one in the renewables sector. There was an 11% vote against last time, and in the other one it was 24% vote against. And they're both still trading, I think, outside that 10% range at the moment, if I'm correct.
That's right. And there's a number of others, like Next Energy, like FGen, etc. So there's a whole range of these funds.
Yeah. And so I suppose it's possible to know, but you would expect we will be hearing more, therefore, from the boards before those thresholds come round again. And this will be one of the triggers for action that you were talking about earlier on.
Yeah, that's right. And at the very least, the boards will have to put out full year accounts and talk about the discount, talk about what they're doing around that, actions to date, how they see things developing going forward, and then potentially offer, whether it's enhanced asset sale programs or fee reductions, etc., as moves to be sort of more shareholder friendly. Obviously, it's up to shareholders for the outcome of those votes, but on balance, you would expect more pressure on those votes, a little bit more pressure than last time around.
I mean, we heard, I think, only this week from Gresham House Energy Storage, which is Ticker Grid, that they were proposing to move to basing their fees half on market value and half on NAV. Is that the kind of direction of travel that you were talking about?
Yeah, possibly. Yeah, it's it's a really shareholder-friendly move. So yeah, it's not limited to that sort of thing, but yeah, it's one example.
So I guess one question that observers like myself would ask would be, do you think that boards have actually been a bit slow in coming to recognize that they need to do something? I mean, it's been interesting. There's been a lot of activity in the equity sector, as say. Renewables have started to make some move, infrastructure likewise, but it's been relatively small scale, and they haven't been able to do much in the way of buybacks, of course, because they're limited by the constraints of what they do and how they're financed.
It's difficult, isn't it? Because the world has changed. Looking back, and particularly from a shareholder's perspective, then shareholders, I imagine, would want boards to do a lot more, but there's obviously constraints on what they can do. And it differs between boards as well. I mean, some boards have been very proactive and some, I think, are still lagging.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. To sign up today at money-makers.co. And thank you for listening. Let's talk briefly about private equity. What do you expect to see happening in the private equity sector this year? Obviously, there has been an encouraging sign that NAVs have been perking up a little, as reported recently, and discounts have come in a little bit for some trusts, perhaps more than a little bit. But there's more to come from that sector, do you think?
Yeah, that's very apt. We're pretty positive in private equity because, I mean, number one, there has been a debate about whether investors should believe the marks and believe the NAVs, but we firmly believe them. I think there's enough transactional evidence there historically to show that the NAVs are valid. But the bigger thing is that there's been so far a limited recovery in private equity exits. But we think that when we see a more established recovery, then the funds are really going to benefit from that because they haven't sold many assets over the last couple of years. So a lot of the funds are in this sort of 4 to 5 year portfolio maturity sweet spot, where if you get a much better exit environment, they will start to sell a lot of their underlying holdings and hopefully realize NAV uplifts. And then a number of the funds have got capital allocation policies where they'll take some of the excess cash flow from those exits and divert it share buybacks. So we think as and when we do get a stronger exit environment, we could get, number one, some decent NAV growth, but also some meaningful discount contraction.
Yes, and so is there any going back from these cases where trusts have actually adopted capital allocation policies, which are a bit more, I guess, shareholder friendly, you could say? In the past, well, I've got the impression that private equity managers, at least, weren't particularly fussed about the fact that their trust always traded at a big discount. But what we've seen happening recently with these new capital allocation policies and greater disclosure in some cases, is that here to stay, would you say?
Oh, yeah, I think definitely. And the policies are quite cleverly designed. So if there's not enough distributions, these policies don't, in effect, activate. And so the funds can always meet their capital calls because that's the primary thing. They can't put that at risk. But like when a number of funds introduce dividends, it's difficult to row back on that. So I think that they have to commit these capital allocation policies. And if discounts remain wide, potentially review them.
You put out an interesting note the other day talking about the kind of feedback you got from investors when you went around talking about the outlook for 2025. Perhaps you could summarize what those main kind of themes were that came out of your conversations. These are obviously on the whole larger investors. What was the feedback that you were getting from them?
We've actually covered a few bits of it today. I mean, there seems to be an investor preference for higher risk return funds within peer groups, whether that's infrastructure or whether it's renewables. At this stage, there's not a lot of sort of nitpicking over various sort of DCF valuation assumptions because there's just bigger issues at play in the market, and that's the big technical malaise and the wide discounts, etc. If we think about private equity, investors are generally actually pretty positive on those names, given the wide discounts, the impending recovery and exits. Sometimes there's a bit of pushback on some of those names because people say, well, why don't I just buy an ETF with like Russell 2000 or something like that? But a number of the funds have got sort of good long-term value creation credentials. And then the overriding theme, I think, is corporate activity, where funds generally need to, when you're on meaningful discounts, firmly justify your existence.
If we get some kind of improvement in demand, how far away are we from seeing any new issues across the alternative sector?
Yeah, it feels like we're a long way at the moment. I mean, it's almost turned the question on its head is what would a new issue have to have at this stage? It would have to be a sort of a niche proposition which you can't get elsewhere because there's no point paying NAV if you can pay a 20, 30 discount. It would have to have very tight discount control, attractive fees, potentially some sort of stake in the GP or maybe GP economics. But it just feels we're currently a long way from that. When we speak to investors, they're focused on existing holdings, on working through current situations. And if they're lucky, they've got capital to deploy in some of the wide discounts, but they're not really focused on new opportunities, new funds at this stage, because that's where the sector's at.
It certainly does seem quite a long way away. Yeah. Can I ask you about one specific sector, what your thoughts are, or two actually, what your thoughts are on the battery storage trusts? I mentioned those. I mean, they've been obviously in the eye of a terrible storm on there, I guess one would say. But we do have a new government that is meant to be favourable to green energy and wants to make the UK net zero. So remind us what the issues have been with the battery storage trusts, and have we seen any evidence that the environment in which they're operating has been improving and is going to go on improving to their benefit?
The big issue really is that the revenue from batteries, mainly GB batteries, collapsed. And at that point, investors stopped believing the forward-looking revenue assumptions, which are understandably very subjective. Because if you think about a renewable fund, you have a long-term power price curve. But on a battery fund, it's almost like the second derivative. It's the longer term volatility in the power curve. So it's even more difficult to predict. And so basically, investors want to stop believing NAVs. And when that happens, funds can go to very wide discounts. And also, clearly, 2 out of the 3 funds eliminated their dividends as well. And so created some forced sellers in the process. Where we're at now is actually an interesting juncture because Harmony, one of the funds, was due to sell its portfolio. And that's a portfolio of operational GB batteries. And we've never had a transaction in the market for operational GB batteries. So that transaction has huge read across, mainly to Grid, but also to Gore Street, many other funds, and will have a very strong bearing on the near-term share price performance of those funds. And if it's a good transaction, investors can start to believe the NAVs again, and then they can focus on the operational side as well, which is improving, and maybe the sentiment for those funds starts to really recover.
What sort of timetable are we expecting for that news from Harmony Energy? Do we know?
I think they've earmarked February from the announcements. Obviously, in asset sale processes, things can get delayed, but it's fairly imminent.
Okay, and then I wanted to also ask you about digital infrastructure, where it's been very much a kind of tale of 2 very different vehicles. Digital 9, which is on the way out, is disappearing after being very disappointing. And that leaves Cordiant, which has, I think, been attracting some support from investors because it appears not to be tarred by the same issues that has affected Digital 9. What is your verdict on what went wrong with Digital 9, and do you share that perspective on Cordiant?
I think on Digital 9, it wasn't a complete case of buying the wrong assets. I mean, like Verne Global, I think, was actually a really good asset. But I mean, after they bought Arqiva, the fund became capital constrained, and then they couldn't fund the capex to grow the assets. And I think that was the big problem. And then the fund had the wrong capital structure. And then obviously going to a discount meant they could raise equity. Again, they couldn't fund those assets from a growth capex perspective, and was basically a forced seller. And you can see that in the Verne valuation, and to an extent now in the Aquacom's valuation at the point of sale. So it's just, multiple things went wrong all at the same time, and it's been a bit of a nightmare. But on Cord, it's the complete opposite story, where they've bought cheap assets and the management team are delivering on growing the earnings from those assets. And because those assets are cash generative, they can take the cash flows and fund a lot of that growth capex and slowly transform these assets. I mean, I went out to Prague last year and saw a number of their data centers, and it's increasingly impressive what they're doing. And that's just on one of the companies. Clearly, they've got other portfolio companies where they're doing other transformations.
And finally then, Matt, we've talked about risk, we've talked about an environment where maybe we're going to see interest rates continue to come down a little bit. How should we think about the growth capital sector? I mean, obviously there's scope for some performance there, but I think most of them are still trading well below their previous highs. Is there appetite for that? Did you get any feedback on whether there's actually appetite for the growth capital companies that we have, such as Chrysalis, Schiehallion, and others?
The main source of appetite in those types of funds is getting access to types of companies which you can't find on public markets. What's going to drive that subsector really is the IPO window. Is that, we've got this cat flap like IPO window at the moment where it's open for a bit, then it's shut. But what we need is a sustained opening of the IPO windows and some material IPOs to happen on both sides of the Atlantic. And then you would expect those funds to re-rate because the funds are buying back. But without exits or without a material IPO in the portfolios, liquidity is always going to be a bit limited.
So do you think the experiment, if you like, with some of these trusts has been worthwhile, looking back over the history of it?
I think it's too early to tell, isn't it? Unfortunately, because a lot of the funds which are struggling right now are, a fairly recent IPOs where they haven't even had the chance to prove the model because they ran into that severe movement in interest rates. So I think in a couple of years' time, hopefully they've got more track record, but also know what the outcome is on discounts and whether they've earned a right to survive.
But isn't this generally one of the problems that the investment trust sector has? These things only came to market in a way because it was a zero interest rate environment and people were prepared to take a punt on these things. Obviously, it hasn't worked out very well, but there is perhaps an element of that, which is, you get the pro-cyclical stuff, but then it goes wrong and then you don't get any other things coming along for a while. So it is an issue over time. I guess investors get a little bit greedy during the good time. Would that be fair?
Yeah, and brokers too.
Surely not.
And I completely agree with the pro-cyclical point that's one of the issues with the sector is when you're raising money for a number of parties for an IPO, then assets have to be fairly sort of hot, in inverted commas, to get an IPO away. So inevitably that can cause problems down the line. But the structure works. It works for liquid assets. It works for income. It works for a bit of gearing. And it's just you want to see the structure work through a cycle. And at the moment, we're just at hopefully a sort of cyclical ebb.
Very good. So, brokers are always positive. We know that. But you think, well, at least you're hoping that this year we're going to see some substance behind the hope. It didn't happen last year on the whole. But this year in your sectors, at least, you're feeling perhaps more positive than you were?
Yeah, we really have to be. But yeah, that's fair.
Very good. So that was Matt Hose, who is the alternatives analyst at the broker and investment bank Jeffries, talking to me this week.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.